Britain is one of the richest countries in the world. Yet today, public services are collapsing, wages have stagnated, and debt is spiraling out of control. Many economists warn the UK is closer to economic collapse than at any time since the 1970s. In this video, we'll break down the data to see why the UK might be heading for an IMF-style bailout. We'll use the latest figures to explain where the pressure points are, and how close this all could come to a full crisis. Hit subscribe if you want concise, sourced breakdowns. Let's get into the numbers. Nearly 46% of children in large families now live below the poverty line. Homelessness has more than doubled since 2010. NHS waiting lists exploded from 2.5 million in 2010 to more than 7.5 million today. And real wages remain stuck below 2007 levels. This is a lost generation of wage growth. Fewer opportunities, more precarity. These numbers are not just statistics, they represent growing social strain. Debt to GDP has surged from 107% in 2023 to 113% in 2024, the highest in decades. The UK spends £105 billion a year just servicing debt, more than its entire education budget. When gilt yields hit 5.4% in 2025, it showed markets no longer trust the government's finances. High yields raise borrowing costs, squeezing services and investment. Inflation has eased from 11% in 2022 to around 2.5%, but services inflation remains stubborn at 5%. Mortgage payments now eat up 42% of disposable household income, pushing thousands into arrears. That combination risks a housing market shock if interest rates stay high. GDP growth is stuck at less than 1%, and productivity has flatlined since 2008. If pre-crisis trends had continued, UK workers would be earning £10,000 more each year. Instead, the economy is trapped in a low-growth cycle the Bank of England warns could become permanent. Breaking that cycle requires investment, skills, and faster innovation. Britain builds just 220,000 homes a year, far below the 600,000 needed. Household debt now equals 85% of GDP, among the highest in the world. The housing shortage traps families, widens inequality, and strangles productivity. Brexit has left trade about 15% below its pre-Brexit trend. Energy costs remain 30 to 40% above the EU average, driven by reliance on imported gas. Analysts warn of a bond strike, where investors demand higher returns just to keep lending to the UK government. These external pressures compound domestic weaknesses. The UK's AI industry could reach $1 trillion by 2035 and has attracted £20 billion of private investment. But without reskilling policies, this revolution could hollow out the middle class. Law, medicine, transport, and call centers are all at risk of automation, amplifying inequality rather than reducing it. Policy choices will determine whether AI is a windfall or a widening fault line. In 1976, Britain had to beg the IMF for a bailout. Debt was 65% of GDP back then, though inflation was higher. Today, debt is 113% and productivity is stagnant. Unlike the 1970s, there is no North Sea oil windfall. Analysts warn another IMF rescue, with far harsher austerity than 2010, is no longer unthinkable. Britain is not bankrupt yet, but it is dangerously close to collapse. With debt at record highs, growth stuck near zero, and markets demanding crisis-era interest rates, the UK faces a real risk of intervention. Without bold action on housing, infrastructure, skills, and innovation, collapse may become reality. The Channel 4 documentary Skint said it best: Britain is rich but broken. If you found this breakdown useful, subscribe, comment your thoughts below, and share this video to keep the conversation going.